This is the concluding lecture of this course. In this course, we took a detailed look on what time decay is. We first examined time decay in our real-world examples of the real estate as well as the insurance examples. And then we went into the trading platform and did a detailed analysis of time decay using Apple options on the Thinkorswim platform. Now you have a very good idea of how time decay works, but there are still a lot more subtleties to time decay, and the only way you're going to get to that is when you do actual trades, and especially when it comes to credit spreads. That's when you're going to see the nuances of time decay strategies, because credit spreads are the basis for time decay strategies. And so that's coming up in course 4. And but this course, we've finished the theory of options, all the theory behind options. So in the first course, we studied the theory behind options themselves. Then we looked at call options and put options. And in this course, we did time decay, implied volatility, and the option Greeks. Implied volatility, if it hasn't yet sunk in, let me tell you that implied volatility is truly the wild card in options pricing. So if you're going to be buying options, you need to make sure that you're buying options that have a relatively low volatility environment for that stock at this time. Now, how do you know if a volatility is low or high, and what is the standard? So that's a very good question, and we'll be covering that in the later courses, because that by itself is an involved discussion. But implied volatility is very important, and you saw it in action in the Caterpillar and Netflix option chains. This example should be absolutely clear as to how severely implied volatility can impact option prices. So that's a very critical component of options pricing. And then finally, we looked at the option Greeks. Because we have 3 parameters that moves option prices. We have the price movement of the stock, we have implied volatility, and we have time decay. We also have Greeks associated with those parameters. Bear in mind, all these Greeks are mathematical calculations, so it's all derived from the Black-Scholes formula. So these are all mathematical calculations, and once you know the price of an option, you can pretty much back out all these Greeks, provided you know all the other parameters, like what is the expiry series, what is the strike price, what is the current price, and things like that. So once you know these, then all these Greeks can be backed out. And the most important Greek, of course, is going to be delta, because delta is your sensitivity to the price movement in the stock. So under normal circumstances, which is about 95% of the time, your option price is going to be most sensitive to price movement. So 95% of the time, you can look at your delta, and you'll have a pretty good idea of how your option, how your position is going to fare. The other 5% of the time is for very extreme or extraordinary situations, like when you have a major market crash going on, or a flash crash type event where the volatility starts to spike up beyond reasonable levels. So if such a situation is going on, then your position is probably going to be more sensitive to Vega than it is to Delta. However, when such a situation is going on, you're going to have large movements in price, so you can almost guarantee that even your Delta sensitivity is going to be very, very high. So those are the things that you'll need to understand. Option gamma is a little difficult to understand, so let's face it, and don't be concerned if you do not understand this at this point fully. Like I said in the description, it takes option traders sometimes up to a year to fully understand how gamma works. And fortunately, the effects of gamma are pronounced only in a very couple of narrow situations. So, when we do deal with those situations, I'll be pointing them out in all the future courses. Then finally, we looked at the options market structure. We looked at all the different order types, what the market maker's role is, what is an expiry series, what is exercise and assignment, open interest, volume, and all of that stuff there. So congratulations, between course 1 and course 2, we have you finished the theoretical parts of options. So this is the theory that needs to be done, and you've gotten a very good idea of this theory now. Now, when we go into actual trading, you're going to find that there is so much more to all of these things. Okay, so I don't want you to think that you know everything and now you're going to be able to trade very successfully. No, not at all. This theoretical foundation is only the starting point. And when we go real life into live trading examples, and once you understand all the different market dynamics and all the crowd psychology and crowd behavior that goes into markets, all of these things are going to be a lot more complex. So while you have a very, very good foundation, now it's time to go into live trading examples. We'll start with the basic options, which is the long call and the long put. And then in course 4, we are going to deal with option spreads. And so option spreads, I want you to take your time with option spreads. If you've seen the roadmap, to master option spreads will take you about 3 to 6 months, depending on how much time you have on your hands. But let's focus on the single options for now. We'll get to option spreads. And like I said, our goal is by the end of this 9 to 12 month period, we want to be in a very comfortable, in a very desirable position. And that position is we should have learned option spreads. We should be a master of option spreads. And that really gives you the skills to create monthly income strategies on a consistent basis. Thank you for watching this course. If you have any questions, please send me an email at info@optiontiger.com. Otherwise, I look forward to seeing you in the future courses. Thank you.